What does the amendment entail? Because the budget had proposed that a portion of the distributed income, which is in the form of debt repayment, should come under the tax net, to which the industry had represented to really soften the burden. What has happened in the amendment?
So, Nisha, firstly, the burden has been softened, and I'll tell you how that has happened. Like you rightly said, in the finance bill, the original one which was announced in February, what was proposed was that a portion of the distribution, which was in the nature of loan repayment, would get taxed in the hands of the unit holders under the full rate, which is under income from other sources, effectively going all the way up to 39% in case of HNIs. Now, what is got enacted and the amendment that was tabled before the Lok Sabha and what's been enacted is that the tax will now not be on the amount distributed as loan repayment, but what is a specified amount. They've prescribed a formula for specified amounts, and I'll not get into that technicals. What effectively they've done is to say that from this amount, which would otherwise be taxable as other sources, you are now permitted to reduce whatever would be the issue price of the unit. Therefore, in short, what they have done is, insofar as the REIT is concerned, to the extent that the return of this amount represents what has been collected or it is a return of the capital that they've already raised, then there won't be a tax under other sources. So that 39% tax or the slab rate tax won't kick in on this amount to the extent that this repayment is the issue price. So I'll take an example. If somebody
Ajay, let me break it down right now.
Sure.
So the distributed, debt repayment minus the cost of acquisition is the only amount which is taxable. Now, in my understanding, it was supposed to be up to from 30 to 39, depending on the category of the investor, it would be taxed. Does it stand there, or does the capital gains kick in there?
So it's a bit of both. So the moment you exceed that issue price, it is other sources gets taxed at 30 to 39%. But up to that price, what has also happened is there's a corresponding change that they have brought in the capital gains taxation, which means, your cost of acquisition reduces. Therefore, effectively, you end up paying tax on capital gains. So which could be as low as 10% if you have held the unit for 3 years plus. So if you acquire the unit at 100 rupees, but you've got this loan repayment of 100 rupees, you have set it off, then your cost is zero. So whatever you sell thereafter will get taxed as capital gains. So it will become taxable as capital gains eventually. So one, it has got deferred, and second, it's now taxable at a lower rate. That's the softening of the blow.
Right. So if it is coming in the category of capital gains, and as Ajay Rotti has explained, that there are changes in the amendments which pertain to the cost of acquisition calculation in the capital gains component as well. So therefore, the tax burden has softened substantially. Vikaash, come in on this. What is the exact impact on your investors because of this? From earlier, you had stated 40% of the devolution or distribution happens in the form of debt repayment. How are your investors now impacted?
Yeah, sure. Thank you, Nisha. Good afternoon, everyone. So one, we are very pleased with the outcome. As Ajay mentioned, this is beneficial both to institutional and retail investors. Now, if I just take Embassy REITs as an example and give some numbers, if you recollect, as you rightly mentioned previously, we had stated that about 40% of our distributions each quarter comprise of the debt repayment component, which is what we're discussing today in terms of the tax impact. Now, taking this year FY23 midpoint guidance of 21.7 rupees per unit on the distributions, as an example, about rupees 8.7 per unit was a repayment of debt component. Now, assuming an investor had invested at the issue price of 300 rupees a unit, as Ajay rightly mentioned, there would be no upfront tax implication when this 8.7 rupees is distributed as debt repayment this year. Instead, what will happen is it will go towards reducing the cost of acquisition. So, in a sense, together with the dividend component, which is also tax-free, which is about 45%, about 85% of our distributions for FY23, there would be no upfront tax. So it's a huge plus for investor. Now, if the investor were to continue to hold the unit, then the debt amortization component will not be taxed to the point in time where this exceeds the unit price. So for approximately, taking Embassy REIT as an example, for the next 25 to 30 years, there would be no tax impact on this 8.7 rupees, assuming it's constant for the next 25, 30 years, for an investor who continues to hold the unit in the embassy REIT. So we think it's hugely positive. It reduces the tax implication for the retail investor, for all investors, in fact, and it also delays the incidence till the time the REIT unit is actually sold.
So you are saying that for the entire life cycle of the investor, till you do the maths and the calculation on cost of acquisition versus the amount that they have got, and in between spread is the only point or only amount which is going to be taxed, and that too will attract capital gains tax of 10% as applicable at the time of sale of units, and not 32 to 39% as is the taxability of the distributed income under other three categories.
Yeah, based on this example, which I mentioned, Nisha, which is the investor continues to hold, and also, the numbers which I laid out, yes, this is our understanding of the change that has been brought in.
And how have your investors reacted to this change? Are they now happy because their returns were set to get a big body blow? In fact, 2 to 3% is what I gathered from one of your big investors. 2 to 3% of the returns per year was set to be really hit for them. And now all that is unturned and has been changed back to the usual.
Yeah, so a couple of points here. Absolutely you're right. One, we're very pleased. I think the authorities have done a commendable job. REITs, as we mentioned, is a growing asset class. We think it's an imperative in every portfolio. So it does two things. One, it positively impacts the post-tax distribution yield for investors, especially in a world where we're seeing rising interest rate environment. So this impacts positively by over 100 to 150 basis points. This especially benefits the 75,000 odd retail investors invested in embassy REIT, and I'm sure all of our peers in the industry are also equally pleased. Taking a bigger picture view, Nisha, REITs are a total return product, which offers stable and predictable cash flows and also the long-term growth upside.
No, we all understand, Vikaash, this particular asset class. But for the future, would you look at changing your, structure at all now after this change?
Yeah,
do you need to change the structure at all? In one word.
No, we don't need to change the structure. We can relook at it, because what it does, it gives us a breather for 25, 30 years in terms of till the time the distributions don't exceed the cost of the unit price, the investors are not, the tax incident does not happen. So,
all right, completely out of time there, Vikaash, but thank you so much, both Ajay as well as Vikaash, for putting this into perspective. So hugely softened in terms of the tax amount on the debt repayment part of the distribution income for REITs and InvITs. So this particular amendment has been very, very welcome by REITs and InvITs sector. With that, completely out of time on this segment. Take a break and come back for more.